Hi, I'm Rick Kaler. Thanks for joining me. A lot of stock market experts are concerned that the market is overheated and ripe for a new bear market. One of those expecting a bear market is Sean Williams of Motley Fool. In a May 8th, 2021 post, he said, "A case is mounting for a big drop in the stock market." The article cites statistics that in the previous 8 bear markets before last year's pandemic crash, the market has suffered at least one double-digit correction within 3 years of the bear market bottom. 8 previous bear markets, one double-digit correction. Now, I can't say this statistic leaves me terribly frightened. The bottom of the last bear market was March 3rd, 2020. A 12.5% chance that we have a pullback of over 10%, meaning an 87.5% chance of a pullback of under 10%, is probably more encouraging to actually invest in the market rather than pull out. The article does give a statistic that is more concerning, noting that the market is at historic price levels with a Shiller price to earnings ratio of 37.53, which is double the average ratio. Now, the 4 times in history the index went over 30, there was a price decline of 20 to 89%. Williams concludes that there's a very real possibility of a stock market crash coming. Well, he's right. I'd go one step further and say a stock market crash is coming. That's undisputable. The market has averaged a double-digit decline, which we'll call a crash, every 2 years since 1950. Crashes are then normal and to be expected. For long-term investors, stock market crashes are not to be feared. According to an article in Forbes on April 2nd, 2021, it was called Bear Market and Bull Market. What's the difference? The average bear market lasts only 10 months, and the average bull market lasts 3 times that, or 31 months. So the real risk isn't riding out a bear market. It's instead missing the next bull market. Investment advisor Lee Munson, president and CIO of Portfolio Wealth Advisors, emphasized the risk of missing a bull market to me recently, saying, "We fear meltdown so much, the risk of a melt up is never part of the equation for a value or logical investor. It should be." He continued saying, "While my logical side can show you 100 charts of why markets are ready to correct, my time horizon is long-term at the core." Another friend of mine, Tim Maurer, director of advisor development at Buckingham Wealth Advisors, looks at staying the course in the stock market from another angle. In a May 9th, 2021 Forbes article, he writes, "A balanced portfolio that might have a 6% expected rate of return annually will likely never return exactly 6%. It might return 7% one year, 15% the next, -8 in the following." He goes on to argue that selling out one's portfolio when it hit or exceeded the expected long-term return, while working in some short-term instances, it would probably give a net result over time that would be much lower than the expected rate of return and probably wouldn't end up supporting your income goals. So in other words, we need the great years to offset the not so great years in order to reasonably expect a good long-term rate of return. The best long-term investment strategy is to establish a diversified portfolio with 5 or more asset classes Select an allocation of those asset classes that's appropriate for you. Rebalance the portfolio at least once a year and keep your hands off of it in the meantime. It's the keeping your hands off of it that is the huge emotional challenge. Maybe your best move to prepare for the next market crash would be meeting with your financial planner or financial therapist to deal with your emotions. That could be the best investment that you ever make. Thanks for joining me.